Today I'm walking you through a step-by-step plan to help a family pay off 3 credit cards in 6 months using Velocity Banking. Right now their only savings is $300 and their credit cards are maxed out. That means if an emergency comes up, there's no backup. The problem isn't just debt. Their money isn't flowing efficiently. They're juggling bills and paychecks, holding back money here to help pay an upcoming expense there. Their money is being pulled in different directions, which is keeping them from building real financial security. So here's the question. Can this family turn their credit card debt, the kind that would take years to pay off, into a manageable plan that actually frees up cash? That's what we're going to explore today. Let's dive in. I want to align their paychecks with their bills, and in order to do that, I have worksheets that help organize their information. I use the month at a glance worksheet to list everything that must be accounted for in chronological order, and I've asked the client to provide me dates and amounts of paychecks so I can line everything up. I map each paycheck to the bills it can cover by using the money tracker worksheets. This family gets 4 paychecks a month. They are paid on the 1st, the 6th, the 16th, and the 20th. I start their plan on the 20th, and here's why. The 1st and the 16th are going into the checking account, but nothing's really being parked in the checking account. The bulk of these 2 paychecks will be redirected to make a payment on the primary card. The paycheck on the 6th is the largest paycheck for the month, but it comes very close to the primary card's statement closing date. And because the card has been maxed out and they've only been paying minimums, making a large payment right before the statement closes can trigger the bank's risk system. Banks monitor account activity and take a snapshot of our accounts on the statement closing date. If they see sudden volatility, for example, a larger than normal payment on a previously maxed out card, they've been known to reduce credit limits or even freeze accounts temporarily. So we want to avoid that scenario with this family and start with their paycheck on February 20th. Let's walk through exactly how that paycheck is used. Once we know when money arrives, we assign each paycheck a purpose. Here's the plan. Quick note before we walk through the numbers. I don't have access to the family's checking account balance, so I'm not accounting for that, nor am I accounting for what might still need to be cleared from that account. I'm just demonstrating the cash flow logic to show how the Velocity Banking strategy works. When you fill out your own worksheets, you'll add your starting checking account balance here, add it to your paycheck, and put the total here. Anything that still needs to be cleared will be deducted here. But that's something you do when you fill out your worksheets. The goal here today is to understand the flow of how this works. The paycheck on February 20th is $1,808. Out of that paycheck, they will be parking money in their checking account that will be used to pay bills and expenses that must be paid with cash, check, or auto draft. These expenses will be paid directly from their checking account. On the 28th, there's a Capital One loan for $54. On the 1st, an HVAC financing payment for $100, plus $12 in bank fees. On the 7th, a $28 life insurance payment. This cannot be paid with a credit card, so it stays parked here. The electric bill is due on the 9th, and car insurance on the 10th for $120. Even though utilities can be paid with a credit card, they typically charge convenience fees for using that credit card. So the utility payments will be paid from checking for this family. The husband also pulls out $40 cash for spending money, and they leave $300 in checking as a savings buffer. It's savings, but for now, it's going to live in checking as a safety net. That brings the total parked in checking to $1,054. From the $1,808 paycheck, that leaves a remaining $754, and here's what we do with that. That $754 goes as a chunk payment to the primary credit card as soon as possible. I haven't seen the credit card statement, and I don't know the exact interest charged last month, but I do know the APR. So I estimate interest on the high end. I divide that estimate by the number of paychecks they receive in the month and record that amount as an expense. Here I estimated on the high end between $15 and $16. Subtracting $16 from that $754 leaves $738. There's an $83 YouTube TV bill due on the 28th. It can be paid with a credit card, so they'll pay when it's due, not early. The goal is to keep the balance on the credit card as low as possible for as long as possible because interest is charged on your average daily balance. That's why we're making these large chunk payments, to drop that balance and shock the interest calculation to recalculate at that new lower balance. On the 31st, the wife normally sets aside $25 for a quarterly trash bill, but now it's been prepaid on the card. Not to pay the bill yet, but to lower the balance now. That money is doing double duty, reducing interest today and making room for the expense later. Numbers, I've allocated $330 to see them through this pay period for gas, groceries, and household spending. How they choose to spend that $330 is entirely up to them, but that's what's been allocated for this paycheck to carry them through to the next paycheck when the card will be paid down again. If they can do that, $300 remains unspent, and that $300 is what's paying down the principal. With this one paycheck, they've doubled their checking buffer from $300 to $600, covered every bill due this period, and paid down $300 of principal on their debt. The next paycheck arrives on March 1st for $750. No bills are parked in checking for this pay period. The paycheck deposits into checking. The wife withdraws $40 spending money for herself for the next 2 weeks, and the remaining $710 goes straight to the primary credit card. We're not concerned about leaving a buffer in checking. They already have $300 from the paycheck on the 20th, plus the original $300 they started with. The first line item we account for is $15 for interest. I don't have this client's exact statement or interest charge, so as I demonstrated before, I estimate on the high end to stay conservative. In this case, I rounded it to $15 to keep the math clean and easy to follow. Next, we free up $250 for upcoming doctor visits and medications, expenses we know are coming and can be paid with a credit card. Remember, these expenses were provided by the client. That leaves $445. We're going to allocate $395 for variable spending, gas, groceries, household item, and kids' activities for this pay period. This $395 needs to cover them through the statement closing date on their primary card. That's about a 12-day stretch for groceries, gas, and household items. Even with these planned expenses, that can still leave $50 to pay down the principal on the card. That brings the balance down to $1,900. On March 6th, a third paycheck arrives, this time for $2,087. Their primary card is the Capital One Quicksilver. The minimum payment of $89 is due on the 8th. But they do not need to make a payment on the 8th because they've already made a $754 payment on February 20th and a $710 payment on March 1st. Both payments posted within this billing cycle, so the minimum due has already been satisfied. During this pay period, there are 3 other credit cards due, a Kohl's store card and 2 Chase cards. This paycheck arrives on the 6th, and those cards are due on the 16th and the 23rd. I would pay those as soon as this paycheck clears. I would not wait until their due date. Paying them early reduces the average daily balance and lowers the interest charge, so I would take care of that early. After those credit cards are handled, the mortgage is due on the 17th. The water bill is due this pay period, and while utilities often allow credit card payments, again, they typically charge convenience fees, so it makes more sense to pay them from checking. There is also a life insurance payment of $45 that cannot be paid with a credit card, and spending cash for the husband comes out of this paycheck as well. When we total everything that needs to be paid from checking during this pay period, it comes to $1,121. Out of this $2,087 paycheck, that means $966 is available to be paid toward the primary credit card on the 12th. And here's what they're going to do with that. Because this family is only 2 payments into this velocity banking strategy, there hasn't been enough time to establish a consistent payment pattern with the bank yet. It can take up to 3 billing cycles, 90 days, for a credit card company's risk system to recognize a new pattern in payment behavior. So, for this paycheck, I would wait to make the large chunk payment until the day after the statement closing date. The statement closes on the 11th. The new billing cycle for this card starts on the 12th, so I'd make my chunk payment on the 12th. This avoids unnecessary volatility. I don't want them to feel rushed. If they wait to make that chunk payment on the 12th, it reduces the chance of triggering a risk review. Once the $966 from this paycheck is applied to the primary card, we deduct $16 for estimated interest. This large chunk payment prepays the cell phone and the internet bill. This bill isn't due until the 20th, and I don't want them to pay this bill until it's due. We want to keep the balance as low as possible for as long as possible. They're just going to let that $260 work to reduce the daily interest calculation until it's time to pay the cell phone bill. That leaves them with $690 off the balance on their card, but they still have to purchase their gas, groceries, household miscellaneous items, and cover the kids' activities. So based on their spending habits, I've allocated $390 for that. If they can stick to that, then $300 is coming off the principal, bringing the adjusted card balance down to $1,600. The fourth paycheck arrives on March 16th for $750. Like the check from the first, no bills are parked in checking for this pay period. The paycheck deposits into checking. The wife withdraws $40 for her spending money for the next 2 weeks, and the remaining $710 goes straight to the primary card. We're not concerned about leaving a buffer in checking. They already have $300 from the February 20th paycheck plus the original $300 they started with. The first line item is $15 for estimated interest. I rounded it to 15 here to keep the math clean and easy to follow. We free up $250 for upcoming doctor visits and medications, expenses we know are coming and can be paid with a credit card. That leaves $445. We allocate $395 for variable spending for the gas, groceries, household items, and kids' activities. If they stay within budget, the remaining $50 is going directly toward paying down the principal. By the end of one 4-paycheck cycle, 1 month, they will have $600 in their checking account buffer, and the balance on their primary credit card will be reduced from $2,250 to $1,550. They repeat this same 4-paycheck cycle March 20th, April 1st, April 6th, and April 16th. At the end of this second cycle, they should have $900 in their checking account buffer, and the balance on their card should be $850. On April 20th, they start their third paycheck cycle. April 20th, May 1st, May 6th, and May 16th. At the end of this period, they should have $1,200 in their checking account buffer, and the balance on their card is now $150. And it is at this point they're going to switch cards. Why not pay it off? Because we're in a rhythm. This is a 4-paycheck cycle, so we want to make an easy transition to the next card. By keeping this card below 10% utilization while the other 2 cards are being paid down, it dramatically increases their credit score. This card will be paid off, but for the next 3 months, they'll make the $25 minimum payment on that $150 balance. But it's important to note, if they had continued exactly as they had been, not using the card and making only minimum payments, it would have taken 14 years to pay this card off, and because it was sitting at the max limit, it left them no room for emergencies. We didn't add income, we didn't cut their lifestyle, all we did was change how the money moved. This family did not need more discipline, they needed alignment. Once paychecks were matched to the bills, decisions became clearer. Once the credit card was used intentionally, interest stopped doing so much damage. And once a small buffer was protected, stress started to ease. Will they have perfect weeks every week? No, and they don't need to. What matters is the direction they're moving. So watch what happens with the second credit card.